feel like I've already gotten crossways of our friendly neighborhood host in New York, and so I don't want to get any. I don't want to dig a deeper hole at this point.
No, cursing is how you show you're authentic to people. That's what Democrats are doing these days, right? Show you that you're real. You curse. Just like a regular old sailor.
What if you curse in Russian and Italian? Does that make... What's that, Ilya?
You know, you're cosmopolitan.
A lot more.
Yeah, well, you know.
I almost like right on cue.
Yes, like it's right on cue. It's pathetic.
Anyway, I mean, the point is, of course, Trump. I mean, the thing is, for all the beauty that Trump represents for cable news ratings, for instance, how the whole thing has become painfully predictable. Tariff threats, tariff backs off, tax cuts, deficits, we'll make it back later. I mean, if you closed your eyes, you'd just think it was your standard plain vanilla Republican presidency.
It's a what can you say? You know, strip away the people's name at the top, right? Strip away Trump's name. It's a George W. Bush, George H.W. Bush, Ronald Reagan type of spending plan. It's not.
There's
a few things
I think is actually deeply insightful.
There's a few things policy-wise, obviously, when it comes to, you know, Department of Education or canceling the student visas today. Like, I thought he was going to staple a green card to every diploma when he was campaigning back in the fall. Apparently, well, he's going to, but the thing is, there's going to be no more STEM students in the country, so can't staple green cards to them. But obviously, I have very specific issues with those because I think that harming that is going to hurt our long-term productivity. I digress.
I mean, that is totally counterproductive to a million things. And it's a direct assault on America as the intellectual magnet of the world for a long time. And
it's a damn shame.
I'm assuming it's openly racist.
If we're going to reshore manufacturing, how can we have all these educated Harvard grads with their high-paying jobs? We need people to sew Nikes. This is the new regime. If they have Harvard degrees, they're not going to want to go do that. How are we supposed to reshore manufacturing then?
It's bad for the country's long-term productivity. It's just not. It's not good policy. But like aside from like, there's some of the things that I would consider egregious. Just look at the deficit spending. The money's flowing into the market. Is it flowing into the market in places that make the economy more productive long-term? I don't think so. I don't know what removing SNAP funding does for hungry kids makes people more productive. Studies show that it's actually more difficult to learn when you're a child in school if you're hungry. So one of the reasons why we want our kids fed is so that they do a better job learning. And kids that are smarter and get better grades tend to be the kids that start the companies, that employ people that live in this country. So I'm all for feeding kids, right? So again, setting aside some of those differences, deficit spending is up. It's more tax cuts for wealthy people. It's more tax cuts for corporations. It's potential deregulation coming down the pipeline for the banking sector. The tariff stuff is obviously crazy, in my view. It's not going to accomplish any of the things that Trump says it's going to, and obviously the rationale keeps changing on a day-by-day basis at this point in time. But it's becoming just standard Republican fare. Maybe the GOP senators, Rand Paul, Ron Johnson, who over the weekend said things like, this budget shows that direct quote, somebody has to stand up and yell, the emperor has no clothes, Rand Paul said. Everybody is falling in lockstep on this pass the big, beautiful bill. Don't question anything. Well, conservatives do need to stand up and have their voices heard. So like when you get the Rand Pauls and the Ron Johnsons and the John Thunes of the world who are then steering the ship and not the Mike Johnsons and Donald Trumps, the ultimate bill is just going to be Republican classic, Dylan. Will it not? If it's Republican classic with the chaos of Trump tariffs on the side that we continually fade, what's standing in the way of financial assets right now? Banks are near their all-time highs. What wall of worry, I guess?
I mean, the wall of worry is everything's more expensive. Rates are higher, tariffs are 5 times more, and the presidential rhetoric is lousy. There's lots of reasons, and mortgage rates are higher, and corporate refi is higher, and American debt and deficits are rising, and American cost of American borrowing is more, and the dollar is weaker. I mean, I can tell you a real lousy story.
I think
all that.
I think what Chris just said is actually incredibly insightful, and I want to frame it in terms that there's a really great book out there. It's one of several that talks about the cyclicality of U.S. institutional development. That essentially in the U.S. there's a kind of 50-year or so-ish institutional cycle where, and the latest book I read on this, although there's a few of them that kind of take this view. I mean, Dalio talks about a 50-year-ish cycle of the many cycles he talks about. There's another one called The Fourth Turning that sort of talks about this in similar time frames. The one I'm talking about is by George Friedman, who's a geopolitical analyst, and for a long, long time, he used to run a thing called Stratfor, with many acolytes that came out of it. But the book that this is called The Storm Before the Calm. And it talks about how at every major turn of these things, what you have is a failed presidency in the United States where whatever issue needs addressing is addressed with old methods that ultimately fail, and then the revolution commences. Be it Reagan with deregulation and lowering costs and the focus on basically fighting the inflation of the 70s through every possible channel, through the channel of reducing government, through the channel of orienting regulation on business to shareholder value and efficiency and lower costs, globalization, all of these things. It's the more spend-thrift FDR approach. Spend a bunch of money and lift the economy out of the recession. That then is, of course, amplified by the World War, which then gives you the inflation on and on and on and on and on. So every fix produces the next issue. Every subsequent issue is fixed, and a new one emerges. If this is the Republican regular, the sort of Reagan baseline approach to fixing the current issues, when in fact what this administration was elected on was a hope for radicalism, then, and in fact 2025 seems to line up with this 50-year cycle, 2025, 2026 or so, then what we'd be looking for within this framework is for all of this to fail. And for the next thing to, and for that to be the catalyst, for that upheaval to be the catalyst for some real kind of lasting change.
Oh God, Dylan, he just said that Trump's budget is going to give us President AOC in 2028.
I did not say that. Again, new paradigm, something different, something we haven't seen.
Oh, President Radigan in 2028.
As long as it can be done. Listen, if Trump can do it from Mar-a-Lago, I'll do it from Milan. Giorgia Meloni's America's best friend in Europe.
It's true. She is the one who got Trump and Ursula von der Leyen to
von der Leyen.
I don't know. I don't talk so good, Elia, as you've made me feel very distinct in recent weeks. Yeah, she called President Trump over the weekend at Meloni's request, prodding. So.
Oh, really? That's a fun factoid.
That's apparently what the news is. Listen, Italy is inserting itself as a player.
Sure.
Yeah, she's helping with the Iran negotiations, obviously hosting Vance after his visit to the Vatican to meet the new Pope. So positioning themselves very neatly here moving forward. But Ilya, on the other side of all of this good news, because one of the pieces of good news this weekend was that Oman put forth a recommendation that Iran suspends its nuclear enrichment operations for the next 6 months to iron out a deal with the U.S. It does appear that some geopolitical tension is leaving the sphere. It's only a 0.73% drop in oil today, despite the fact that the tariffs are lifted, which is ostensibly supposed to be good news for something that's growth sensitive like oil. Oil and copper both weaker. Is this a tell in the market that tomorrow may be a bit of a less optimistic day for stocks, which are just full of joy and endless hope here on this Tuesday session?
I'm not buying today's rally, and it's not because I'm bearish. It's because it is flimsy.
What do I need to show you, Spivak? What do you need to see? What?
S&P 10K.
I need to see that the rally is built not on the president manufacturing a tempest in the teapot and then taking it away within 48 hours. I need to see that it's rallying on real economic outcomes.
Oh, really? I got bad news for the next 3.5
I need
years
to
for you.
see
This guy.
No, and also I need to see risk
outcomes.
reward.
I mean, what is this?
No, and that's the most important thing. Look at
It's
the
gonna be
risk
a long
reward.
3.5 years.
You're at the high, right? 6,000-ish, a little bit above, is the swing high from what, 5 days ago? You're at it. Are you going to buy into the high? At least give me a break above it. Show me something. Give me a little something. I mean, even just on an intraday, like not intraday, obviously, we're closed today, but even on a day-to-day basis, if you were looking at ES futures overnight and you said, oh man, what a strong rally, I better layer something on before I miss exuberance at tomorrow's U.S. equity cash open in the futures overnight. Is that a risk reward bet that makes sense? In my mind, absolutely not. You're squarely at resistance. Why would you be a buyer here? Assuming you're not a buyer already, of course. If you've been holding, Godspeed.
Why buy here? Well, I mean, we do see that both for ES and NQ today, we get a nice little bit of a rally off of pivot levels that have established themselves going back to last October, November. January in ES, that's north of this 58.50 area. In NQ, it's a little bit different, but we scaled that last week. This dip, not as deep.
These are very auspicious levels.
This is a place where the market's turning, right? Like how, if you punch through last week's highs, I think that's really the operating agenda here, because Nvidia earnings tomorrow, hey, that's a curveball. Could they beat? Obviously, I think the market cares about the guidance. Then again, Nvidia today, it's following a path where, like other companies that have seen their earnings beat, it's trading higher going into the earnings estimate. So, you look at the NASDAQ right now, you get through the highs of last week, 21,550. What's standing in the way, technically speaking, of then an attempt for the highs? I don't know. But conversely, if you see last week's low that was carved out on Friday broken, you're looking at the 1 month moving average potentially breached on a closing basis for the first time since, April 22nd here in NQ. The same thing can be said for the S&P 500, where if you breach last week's low, you're then below your 1 month, and we haven't closed below the 1 month since April 23rd. The momentum profile looks dramatically different. You've lost that levitation in the market. So heading into tomorrow, volatility is really low. Nvidia earnings, we're looking for like a $7, $8 move and change. You're already at 3.21% today, 27.1 IVR. Tom also noted there's not a lot of call skew here in the market right now, barely anything if at all. So before you could go $20, $30 wide, sell the outside calls, this thing could still beat, but because of the IV crush, you could still make a little bit of money. That's not necessarily the trade setup heading into tomorrow. It's a little bit of a unique situation. So Ilya, as we close out the door here, you have made mention, it feels like for every Nvidia earnings cycle for the past year and a half, how the bar keeps getting a little bit higher. They have to not only keep beating, but they have to guide higher into these astronomical numbers moving forward, which at a certain point you kind of reach your ceiling on your total addressable market for a year ahead window. What's the deal with Nvidia for tomorrow? Do you find this setup to be compelling? I'm not saying necessarily go long, go short, but how should traders approach this knowing that there's no significant upside call skew? And as we all know, the tariff talk is certainly going to impact their guidance, which all of us know.
Yes. I think it's a sentiment indicator because obviously this is a huge chunk of market cap. So it's an event risk that the market at this point really treats as like a macro risk, as like a big piece of data or a Fed announcement or some such thing. And ultimately, they've been losing their capacity to surprise higher because the market has pretty effectively benchmarked them at this point. And if what we just saw is instructive, market loves a good headline. The market is not in a kind of broad-based thinking mindset, it would seem. They jumped, to your point, on the consumer confidence data today. That they didn't really look at the breadth of things. One piece of data. Good. Okay. They had a quick 48-hour seesaw on maybe more tariffs on the EU, maybe not. Hey, they liked that. So maybe the headline is good enough, but it seems to be really a data point by data point kind of a thing. And this seems more than anything to do with not so much the prospects of AI or Nvidia or anything like this, and more just a sentiment check. Can you keep the NASDAQ up on whatever number this is going to be?
Dylan, we are done here with overtime for this Tuesday. We're going to be back Wednesday, Thursday this week. Obviously, tomorrow we'll be able to cover the Nvidia earnings, so people should be tuning in then right after last call, as we do every Monday through Thursday, not this week, holiday shortened week, but as we typically do every week, 4 p.m. Eastern, 3 Central, 4 p.m. Eastern, 3 Central, right after last call. So with that, overtime is out of time. For Ilya Spivak in San Francisco, Dylan Raddigan in Milan, I've been Chris Vecchio in New York. Good luck trading. We'll catch everyone tomorrow after a brief break. Ilya Spivak's next with Macro Money. He's also back later on for The Price of Truth with Victor Jones. So be sure to tune in. Go Knicks.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at Tasty Live.
If you missed the live show, here's our cherry on top weekly recap.
Have you ever been banned from any place? Probably.
Just a delivery room? That was it? No other place?
Oh, the delivery room, yeah. Twice.
That's the only one. Twice.
Yeah.
Two-time offender.
You know, my wife gets banned all the time from places. She's confrontational, argumentative, and violent. When she got banned from that one Italian restaurant that was around the corner from her house, that's the only time it really pissed me off. They had the best chicken Vesuvio. And I had to go in there and just say, listen, you banned her, not me. I'm still good, right? You know, they're like, yeah, you're okay.
Are you really going to Buc-ee's?
Yeah.
Will you film it? You film yourself going in, you're like, what up everybody? It's your girl Stasi. I'm here at Buc-ee's. And then you get the food. And then you get the food and then you get to eat in your car.
You eat in the car, you get something on you.
Yes.
It's your shtick.
Yes.
You got to do it.
I never
I love this.
Yes.
I know, right?
Do you know what that's like to go out to a tasty show and you prep your whole speech? You come out there and you see all these people that have driven for miles and miles, and the first thing they say is, "Where's Tony?" And you have to go,
exactly.
He's not here. And the look of just, it goes from excitement to sheer disappointment in an instant.
I've never heard one person say, "Where's Tony?" I've been on the road for 25 years.
You literally, the whole concept you had last year was "Where's Bat?" That was the whole concept of your show.
They did a show about where the bat is without bringing the bat.
I hate to say this, but a buddy of mine owns a mountain there.
Yes.
Owns a mountain?
Something like
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
Stock markets surge after the long weekend break. There's a number of headlines driving them, but once again, the Federal Reserve has come into the purview. And the question is, do these buoyant markets care? That's what we're going to unpick here on Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. And we're going to take a look at what these markets did here and try to figure out why they did it, and then look ahead because we do have some critical event risk now lining up in front of us. I'm going to try to see if we can make sense of what it means. So let's begin here with just a quick look at where the S&P 500 is here as we start the week. We can see last week things got a little bit soggy. We ran into resistance there just ahead of the 6,000 figure on this continuous contract for the S&P 500. That's right here. We can see essentially coming back in to test the underside of this narrower congestion range, the kind of last line of defense here on the way up to retest the year-to-date highs, and recoiled from there and headed lower. And you can see we actually extended quite a bit lower, or attempted to, on Friday, around the idea that U.S. President Donald Trump threatened to impose 50% tariffs on the European Union, ostensibly because the talks to reach some sort of a trade deal between the U.S. and the bloc were going, quote unquote, nowhere. We'll recall that the tariff on the European Union that was announced as part of the so-called Liberation Day announcement that triggered this panic right here, that's been on pause since this decision by the president to put rates above 10% on ice until early July 8th, 9th, give or take, depending on time zone, as it were. And since then, obviously, we've seen a blistering rally. Apparently, talks with the European Union were not progressing fast enough for the president's liking. And so he said that never mind the pause, we're going to go to 50% tariffs by June 1st. And that seems to have been something of a forcing function because over the weekend, the president apparently had an excellent phone call with Ursula von der Leyen of the European Union, and we've now had a pause back to the status quo of the early July cliffhanger versus the early June one. In other words, Friday's tempest in a teapot was unwound. And so the markets find themselves booming here after Friday's sell-off and essentially end up somewhat where they ended up midweek last week as the rally stalled again just around the 6,000 figure. It certainly didn't hurt, and this is perhaps a little bit more substantive of a data point here, that the conference board came out with consumer confidence numbers that showed a potent rebound in May's numbers. Now, these are still sort of woeful numbers in relative terms. We're bouncing off some of the worst levels we'd seen since COVID, so not exactly something to scream about, and certainly well below where we were last year, the year before, and even in 2022 amidst the early parts of the inflation scare. We can see that inflation scare peter out here mid-2022 as an influence on consumer confidence. Obviously, this is the inflation scare in its most pronounced, and then things anchor as the Fed's rate cuts, or rate hikes rather, start to work, and we start to get anchoring here, and things improve. So obviously this is not exactly the best overall reading, but clearly that there was an improvement in these particular numbers, in May's numbers, and that it was consumer confidence that steadied. This is, of course, a very welcome sign, and we can see that here, not only in the assessment of the present situation, where there's a mild uptick, but much more importantly, a sharp pickup in the setting for the expectations index. Now, this 80 line at the 80 level for this indicator, this is where a recession is still indicated. And the fact that we're still below it is not a happy sign at sort of face value. But nevertheless, the markets really liked seeing this, and for obvious reasons. And this is where you get into what seems to really drive the current situation. Now, looking back at first quarter GDP numbers, we're going to get a revision of them later this week. What we saw was a shock decline in GDP. It was down 0.3% year on year. That's this black line right here. And while there was, of course, a ton of focus on the front running of tariffs that gave us this massive surge in imports as well as in inventories, that's this jump in investment. This is business investment in inventory. That's the main driver of this. The real and most important takeaway here was the very small contribution from consumption. In fact, this was the smallest contribution in almost 2 years, going back to a reference point of the second quarter of 2023. And of course, the reason this is so vastly significant is that consumption is overwhelmingly the biggest contributor to economic growth. Breaking down GDP by components, we can see consumption is 68.5% of the total. So you really had to have these massive swings in imports and in inventories for those things to have a meaningful impact, because frankly, they're kind of an afterthought in the overall scheme of things when consumption is that dominant. In fact, when we take the difference between exports and imports, which is how we arrive at their net contribution to GDP, we arrive at something that's barely 5% of the overall total, which obviously is a much smaller influence, and you would need a 40-some+% swing in this contribution to get it to meaningfully alter the calculus. And so when you get a consumer confidence number that suggests this part of the equation is holding up, that's, of course, encouraging. Because if you were worried about the impact of tariffs on the economy, this would be the real world data that you would be looking at. To say that we've gone and arrived at a place that's a legitimate economic threat. And you can and this would be the hard data measure of seeing that. And of course, the first quarter in this sense was very troubling, because what it told you is that consumers are retrenching. Now, if we look at the University of Michigan version of the same data, it is quite a bit more scary. And this is perhaps because the cutoff on this survey is May 13th, and the cutoff on the consumer confidence survey from the conference board is May 19th. So the pause in tariffs, reciprocal tariffs on China, announced on May 12th, perhaps is much more pronounced in the conference board's numbers. There's a little bit more time for it to digest versus these numbers here. And we're going to get these numbers revised at the end of this week, so it'll be interesting to see which way those revisions go. But what we certainly see here is consumers are not of one view, depending on where you look. The University of Michigan would tell you that conditions are deteriorating, and of course, the weak retail sales numbers we saw for April would tell you a similar story. In that sense, this conference board data is, on the one hand, maybe a standout, maybe doesn't quite capture everything and is a little bit odd relative to everything else, but on the other hand, perhaps it is more recently biased and therefore more telling of what's actually going on. And so the story here becomes very interesting indeed, because if we're going to get this kind of seesaw on tariffs this, tariffs that, and ultimately we get ongoing evidence that every time one of these headlines emerges, it is a negotiating tactic, and the baseline position remains a 10% tariff floor, which has been sustained in all of the deal making that we've seen so far, and would amount to a 5-fold increase in the average tariff from 2%, then it is the consequence of that hard part of the equation and not the fuzz around the headlines that ultimately is going to show us what the markets need to see to properly price risk, and whether this bounce here is a pure sentiment reflection after people were biting their nails over the weekend, or if in fact this is a more lasting sort of thing. And for what it's worth, we have seen that in the data that we just saw in the PMI data update from S&P Global, there has been a little bit more of a reprieve, let us say. Now, the trend is still toward a significant slowdown around all of this commotion since the beginning of the year. We can see in the second half of last year, the U.S. economy was growing at some of the fastest that we'd seen since 2021. And as ever, these are PMIs that are centered around 50, where that's neutral. Above 50 is growth. Below 50 is contraction. The further you go below, the faster the contraction. The further you go above, the faster the expansion. And you can see here, not only do we have expansion for the composite index that takes in both manufacturing and services, which is about collectively 80-90% of the economy, but this is some of the fastest activity growth for this whole since back here of late 2021, early 2022. Since then, obviously, there's been a meaningful slowdown and where you've been flirting with standstill over recent months. But the May numbers were encouragingly a little bit more positive. So as we dug into them last week, we saw that most of this seemed to be, again, inventory building. More front-running of tariffs, now with these new deadlines. Whereas employment remained in contraction territory, and most importantly, the prices influence on all of this has been surging. So, with this in mind, we turn to the event risk immediately in front of us. Because the question as to whether markets optimism is sentiment driven or if in fact the markets are shrugging off the economic consequences of increasing the cost of imports fivefold, that question remains open, and for no one perhaps more so than the Fed, which is struggling to set policy in these circumstances. Now, we're going to get minutes in the next 24 hours from the Fed's May meeting, which took place on the 6th and 7th of May. And of course, by the time we get to the 6th and 7th of May, and this is the policy statement from that meeting, we can see that we've unclenched most of this decline. So we're somewhere over here when the Fed meets. We've rallied close to 19% off the low, and we've erased something on the order of 60% or so of this overall sell-off, which is obviously not a bad place to be. The markets have clearly improved here. They've clearly decided that this level of panic is untoward. But then when you look at the tone of the statement here, it is far from channeling the same perspective. Uncertainty around the economic outlook has increased further, the statement says. The committee judges that the risks of higher employment and higher inflation have risen. That is to say, there's been an adverse turn in risks to both sides of the Fed's mandate, and the risks are in conflict. That is to say, we are seeing that Fed officials are worried which way they're going to take rates because they don't know if what they should be prioritizing is the risk of higher inflation and thereby keeping rates elevated, or prioritizing the risk of higher unemployment and speeding on rate cuts. And we can see that even going back to the March set of forecasts here, the last time the Fed updated its expectations, we can see December to March, we see lower growth expectations, higher unemployment expectations, higher inflation expectations. But the outlook for rates is unchanged. And the way the Fed justifies this when they meet, and what Fed Chair Powell explains at the press conference following the March meeting, and more tersely, as it were, following the May meeting, is the Fed just doesn't know. It knows that typically higher tariffs are inflationary and negative for growth, but it doesn't know how this particular episode is going to work out. And so with unemployment relatively low in the fours, and with inflation relatively anchored in the mid-2s, there's a sense that now is not the time to overreact. Now is not the time to do much of anything. Let's sit back and see what will happen. And that's an interesting perspective here because, of course, we can see in the tone here, and it was much more readily apparent in the feisty display that Fed Chair Powell put on at the press conference, whether there is, in fact, something more here. Because clearly policy officials are not nearly as happy with what's going on as the markets are by this point. Clearly, they think that the situation is going in a worse direction, at least as far as uncertainty is, while the markets are clearly recovering and saying this is not as big of a deal as we feared. Now, as far as the Fed's forecast here, we can see they're looking at 50 basis points this year and next. If the current rate, we can see right here, is about 4.4, then what we're looking at here is from 4.4 to 3.9 is 50 basis points, and to 3.4, obviously, is 1% or 100 basis points. And if we take a look at the cumulative setup here, there's 44 basis points that's priced in for this year, so almost in line with what the Fed is thinking, a little bit light, and 52 for next year. So the market is a little bit shy of where the Fed is, but for the most part, these are rounding errors, and there's a little bit of lightness in this year's forecast. So 44 versus 50, the full 50 is there for next year, so you're about 5 basis points shy on the total, 95 versus 100. So the markets and the Fed are basically in line. And when you look at the current way that this is baked in here, you can see you don't really see a rate cut until you get into this September, November area. From here, basically through and into the fourth quarter here, you really don't see significant movement. The Fed is anchored, and as it happens, this is a much more hawkish setting than we'd seen since the beginning of the year. Now, the end point is a lot more aligned now than it was, let's say, in March. And of course, March 19th, we can see that's right here. So it makes sense why the market is much jumpier here than they were earlier in the year, and indeed now. But what you now see is a similar endpoint, a similar 50 basis points in cuts, but whereas at the beginning of the year they were going to be applied relatively smoothly, here there's this sense that the Fed is concerned about tariff inflation risk and so won't act. And so it's really interesting now to then consider, why is it that the Fed is so upset in May? What is it that they're seeing? Is this the usual disconnect between the markets and the Fed, where the markets are more volatile in their reaction function to the news? They're more jumpy. The Fed is more long view oriented and is concerned about the broader sweep of things. Is that why they're more so concerned and the markets less so? Or are they actually seeing something here that makes them worried about this? Are they actually seeing something that's more untoward? And so in looking at these minutes, it'll be very interesting to see why Fed officials are concerned. What is it that got them to be more so combative in May than they were in March, when in fact the upshot of the story was about the same? And here, a look at the bond market is instructive. We can see the growth scare begin in mid-February. This is the S&P going down as that happens, and we can see inflation expectations go down with that scare, reflecting that the slowdown in the economy will overwhelm whatever upward price pressure there is from the tariffs, essentially amounts to a call for recession risk. We can see that sentiment has recovered substantially. The break-even rates have not. They're still suggesting that the path of least resistance is still in the direction of economic weakness. They seem to have made up their mind. And if that starts to show up more acutely for Fed officials, well, then this might start looking like it's offsides. And the markets may well return to looking and watching for signs that the economic pain is arriving, this tariff headline or that notwithstanding. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime. A little bit of a shorter week this week because of the holiday. I'm back here in just 30 minutes time, as I am every Tuesday, with Victor Jones for The Price of Truth, so come and tune in for that. I'll be on for Futures Power Hour as usual, Mondays and Fridays, Friday this week, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
I distinctly remember getting an email from Tasty that Lookback had just been released, and I was doing the most laborious back test on the face of the earth before that. And I did 2 or 3, and I saw how quick it was, and I saw how quick the data was, and basically instantaneously, like, I was hooked. I'd always seen all the stuff on Tasty Live with all the data and all the value I thought that bring, and then it was all of a sudden I could control that and basically make my own segment for myself of what fit. And that democratization technology, I think, drastically changed not only the landscape of what's out there, but drastically changed my ability to learn at such an insane rate. And that's kind of when I developed a little bit more of my own path. I was like, this is the type of trade I exactly want to see, or I'd get some type of inspiration from Tasty Live to look at that. And that's when my consistency went from like 1 to 30, and I haven't had an unprofitable quarter since.
Calling all traders. Are you using Tasty Live mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, Tasty Live has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you'd like a chance to share your trading journey and inspire others.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan the tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
What is going on, everybody, and welcome back to Risk of the Week with Gus and E. It is another Risk of the Week. We're going to be putting on some new positions. We'll touch on some of the positions that we already had on from last week and the prior weeks. But we'll do a little tour to market and then also just get a little update on what's been going on so far. But before we do that, Gus, what's going on, brother? How we doing?
Oh man, more's going on than usual. It's been an exciting 24 hours for me. I had some flight cancellations last night that have left me stranded in Texas, but thanks to the kindness of some of my best friends, I was put up for the evening, and it's been all good. Been able to work from here today, but we never stop trading. So I'm here, happy to be here, ready to dive into to this market action. It was a green day, and those are always good for Mr. Long Delta over here. So I'm happy.
Every time I see another leg up in the market and the market just ripping higher, I'm just like, Gus's portfolio right now, bro. Them shares are absolutely cooking. But no, I'm glad things are going well on your end. I hope you have rest of the safe travels and all of that. What's going on with the flights? Is there more of like a wave of flight cancellations? Give me an update. What's going on in the airport?
No, I believe it was just a weather thing last night. Just big storms rolling over Texas, and flying out of College Station here, you have to connect to Dallas. It's the only place they fly to. And so my flight to Dallas got pushed back and back and back, and suddenly I was going to miss my connection to Chicago. Did a quick check. No later flights going out from Dallas to Chicago, so I was just kind of sunk and had to push everything back by 24 hours. But no changeover fee. It was super easy to do. First time I've ever. I changed them over on my phone. I don't know if you ever bought plane tickets on your phone. It feels wrong. That feels like a computer activity. But you gotta do what you gotta do in desperate times. So
I hear you. Yeah. What's going on, guys? What's going on, Lone? I know, and back to the point you made with the cell phones, the best piece of software is made was number one, before I go back to the planes, number one, being able to type in the code that gets sent to your phone and it automatically pops up right as a recommendation on your phone right above the keyboard. And then number two, QR codes for flights. Like I know getting a delayed flight, like having that notification sent right to my phone or having the QR code right on my phone just makes me feel so much more secure, and it's just so much more accessible. So shout out to those little pieces of technology that get looked over on a regular day basis, because they really...
that's a good shout out. That is a major quality of life now that it autofills codes when you have to verify logging into an account. It just says from messages and pulls right up. That's awesome. Yeah, big shout out to Apple for that one.
Oh yeah, absolutely. Other than that,
was probably doing it a year sooner. That's probably what's going to be said in the comments.
A year, probably 5 years.
Had to beat by a year. Yeah, you're right.
Go into the comment section of any iPhone versus Android debate. I guarantee all Android letting you know that came out 8 years ago before you were born. So, new risk of the week. The market had an insane rally to the upside today. I mean, taking off from market open and can't stop, won't stop. So we really rallied today. We'll get into that. But we do have a new risk of the week. So I'm excited to get into this week. This is the week where we put on new positions. And we just put on a little, I wouldn't say riskier positions. Our risk is still managed really well, but we definitely put on some speculation in these ones. So always look forward to that.
I would classify it as risky positions that are done within the risk tolerance of our portfolios. It's it's fun to take a little bit of risk as long as you're careful about it, and there can be profitable angles to be had. So yeah, this week I'm going with a not particularly risky name. I found a way to inject some risk into the contract that I'm trading here. I just have a Apple 613 naked call 210 strike. This is actually a pretty TA heavy play, more TA heavy than I've been being in most of my plays as of late. But Apple, it's been a nice channel, pretty much perfectly 193 to 214 range since the beginning of April. With this last down move, we just got another perfect bounce right off 193. There was a nice quote that came out this morning from National Economic Council Director Kevin Hassett. There's so many positions in the government, holy cow. But he said explicitly that the Trump administration does not want to harm Apple with these tariffs if they can avoid doing so. So they're specifically thinking about Apple and keeping Apple in mind as these trade talks go on. I think that's a very interesting and slightly bullish thing for the stock. As I said, not a risky name. You don't really hear people talking about high risk Apple trades very often, but it's naked, it's 10 DTE. 13 DTE rather. It's 5% out of the money, plenty of risk here, and I'm looking to get out within a week. This is not a hold until expiration sort of situation with my defined risk plays. Errol knows well I like to milk every single drop of profit that I can out of them if they're going to expire in the money. Not the case here. Just looking for a nice move up. Ideally into the 210 range. If we only get 205 or something like that, I would happily take my profits and run as well. So Apple is the risk this week.
Yeah. No, I mean, I like Apple. Apple's one never had any issues with. Pretty liquid. Premiums are usually really solid. I mean, not the most risky asset, but I mean, the overall market's really volatile. So I mean, you could definitely squeeze out a lot of points on something like Apple. I'm usually of the proponent of like really milking certain contracts. I haven't done that too much recently, but I'm definitely of a proponent. So I mean, I like this move, and you've definitely been capitalizing on and milking some of them other ones. So throwing Apple into the mix is always a solid one. We'll definitely get some type of move. But I like it. Any other ones you were kind of considering before Apple? Were you kind of juggling before?
Well, I think it's one that I've actually already burned as risk of the week, but I did, in a somewhat speculative way, add to my Qualcomm position today. I've been working Qualcomm to the upside for a little while. I have mid-September 160s, and I just added a 170 today amid this little dip that just happened, and now we seem to be rebounding nicely. Qualcomm, I like their fundamentals. I don't really think that they're going to be hit too hard by tariffs by my calculations. So, I got some Qualcomm leaps. That was certainly also in the equation here.
Yeah, no, I love it. Qualcomm, another steady one. We got Disney. We're kind of
Great picture.
I know. I was literally sifting through them. I was like, no, this one. Now I was like, nah, this one's the right one. Like this one just gives you, I don't know, a very calming feeling. So I hope we can appreciate the graphic that we have for Disney on the day. Shout out to all of our Disney lovers. I know Tom isn't a huge advocate for anything like Disney. So, but I hope we can still show some appreciation towards the photo. But no, we got Disney for this week. So really not too far off of like an Apple. It's another one of those blue chip, quote unquote, safer underlines to kind of go with. But I do have a little bit of a riskier position on them. I'm going to be buying a put. I wouldn't say too risky. It's a little bit more aggressive directionally is what I'll say. But I bought a put in Disney, bought the 110 put. Disney, just a couple headlines on Disney before we get to it, because some of these might sound like very bullish news. So it's like, Errol, why are you buying a put right now? Disney did announce potentially building some parks in Dubai. I don't know if anybody heard of this news, but I'm curious to see how that works out. I'm curious to see what that infrastructure is going to look like. I know Dubai really likes to have a little pizzazz on a lot of their architecture out there. So I'm kind of curious just to see what that build is going to look like. Excuse me. And then there was also a fire that broke out in Disney World. I think this was a little bit earlier last month, maybe early March, I believe it was. But there was a fire that broke out just for some other news on Disney. So that was your first time going to Disney, probably ruined the experience for you. But there will be one out in Dubai. But I wanted to buy this one. This one's going to be out in July 18th. Not paying too much for it. We'll get into the platform here in a moment. It was a lower IV environment, so that's why I went with buying the puts instead of selling the puts. So we'll see how that works out. IV is fairly low, premiums are fairly decent. I did buy the at the money, so it is a little aggressive there. But other than that, I'm going to be risking the debit that I pay for the position. That's how I'm going to manage the risk on the trade, and hopefully we get a directional move. Disney's gone absolutely ham to the upside, along with the rest of the market. So it's been up about 30%-ish, nearly 30% in the last month and a half, maybe about 6-7 weeks. So maybe we can finally get a little bit of downside, but we're buying the put. We're getting a little bit more aggressive here. But Disney was a play on the day, Gus.
Yeah, I like it. It's interesting.
Yeah.
I hadn't heard about the fire at Disney World. I had heard about the Dubai theme parks, which, I think is interesting. That's a very big area of expansion on the world stage right now. I mean, there's all kinds of things going on in Dubai, and I think that it's smart for Disney to throw a park there. I also, as I was reading the Disney Dubai news, learned that they have way more parks than I was privy to. I didn't know that they had one in Tokyo. I thought it was just Orlando, LA, Paris, and apparently there's like 7. So I wasn't not too sharp on my Disney knowledge there. But yeah, I like this one. I agree with buying the puts in the low IV environment. I think you hit the nail right on the head there. And yeah, I think that this is an interesting play. I'm trying to contemplate what kind of burden I think tariffs put on Disney, and how much that affects their overall macro. But any tariff news would be good news for this trade. So yeah, I'm here for it. I'm rocking with it.
Yeah, no, I hear you. I know I wasn't really too privy about all the other locations that they had of Disney World or, Disney parks, at least for that matter. One of my buddies, Matthew, he runs a YouTube channel, but he did one of the challenges of like being at every Disney World in like a span of whatever hours. And then when I saw, I was like, yo, they got one here, and here. They have all their different cultures depending on what the theme park is. And depending on the culture, some Disney elements or characters and stories are more popular in other areas. So, they'll build out and focus a little bit more on those elements. So kind of interesting to see. Reminds me of the McDonald's. I know the McDonald's in other areas of the world will have the menus tailored to whatever, culture that they're in and what's a little bit more popular. So kind of same thing I saw there with the Disney Worlds.
Yeah, I had I'll tell you what, I had a McChicken that had bacon and ranch on it one time when I was in Spain. That was pretty awesome.
What do you mean? You say this like this just ended up in your lap, in your mouth. Like,
yeah, it sort of was. We
like you didn't order it.
Yeah, I'm not one to like try to hit McDonald's when I go to international destinations, but it was a strange spur of the moment thing in the train station where we realized we were in a squeeze for food all of a sudden, and we were like, let's try the Spanish McDonald's. But yeah, I don't remember what it was called, but it was essentially a chicken sandwich with bacon and then some kind of ranch sauce going on. It was delicious. They should bring that thing to America. That's my petition to McDonald's.
Cannot be worse than a fish fillet. And I think you like the fish. Hey, look, I don't mean to offend anybody, but I mean, that's not real fish. That's deer.
I am a fish fillet enjoyer. I've had to defend this take a number of times.
You have to defend this take.
It's not. People say it's not real fish. It's just I think about it like a frozen fish stick that I would make at home. Like it's not going to be the best quality fish, but I think it's fish. It's just a little frozen brick of fish that they toss in the fryer.
I mean, that's a good point.
They got good tartar sauce. It's good. It's good.
That's a good point. We'll see with the fish fillet. Maybe one day we try one of those. I don't know if you've been out to the McDonald's that's out in, as we transition here into the platform, but I don't know if you've been out to the McDonald's out in Chicago, the one where you can order all the international type food. Have you checked out
the giant one like next to Fogo de Chao? Is that the one?
Yeah, did you go over there? Yeah.
I haven't been there yet. I've driven and walked past it a number of times, but I haven't had the chance to get out. I actually didn't even realize it was an international thing. I thought it was just a giant McDonald's. So
you can order a lot of things from other locations.
I saw their sunsetting Cosmics. I never got to go to a Cosmics location. Do you know what is
Cosmics? No, I don't think
it was like McDonald's offshoot brand. They tried to start like a coffee shop swig almost style deal where they would sell like strange specialty drinks. They had a bunch of locations.
Oh, I did hear something about that. I did.
Yeah, but they're shutting it down now.
I don't know.
I wanted to go.
I don't know if I'm off the mark on this one, but I think that type of industry was getting really competitive, especially with things like Dutch Bros. Saw a lot of success in like a drink only type spot. I don't know if that's something similar they were trying to shoot for, or
I think that it was like sort of Dutch Bros, but also like Swig is really popular. I don't know if you guys have Swig down in Florida yet, but it's a soda. It's like a coffee shop style thing, but it's just soda. They'll do all sorts of different soda mixes for you. They started in Utah because Mormons can't have caffeine or alcohol, so it's like a nice little mixed drink sort of thing, and then they've expanded outward from there. We're finally just getting them down in Texas. I don't think I've seen one up in Chicago, but yeah, Swig is really rapidly expanding, and cities are excited when they get those. So I think that was part of the inspiration. Somebody in the comments back me up. I know somebody's had Swig. It's
good. I like the name. Whoever chose the name, I love the marketing for that. I mean, Swig, that's fire for a soda.
Yeah, it is. It's good branding too. It's clean. Yeah, and they're really, really tiny locations. I mean, like smaller than a house, just like a little tiny box, basically. No sit down. It's a drive-through only.
Oh, shout out Swig. Let us get some Swigs and sip that on during the segment. But we got Disney here. This is what I was kind of pointing out with that rally from early April. So it's been going on a tear alongside the overall market, but I know it's about 30 points. It's about a 33-point run since early April. It might not sound like the craziest run, but percentage wise, I mean, the underlying really isn't that expensive. So I mean, an $80 run all the way to around 112, 13, 14 bucks is a pretty good run percentage wise. So we'll see what we get over here in Disney. IB rank's still sitting at 16 right now. I think it's been going up a little bit. So, I mean, if we get that, I don't want to say crash, but if we get some type of significant pullback, that'll be nice. Buying these puts, hopefully get an expansion in vol as well, pump those premiums a little bit. But, wishful thinking when it comes to some of these positions. We'll see what happens. Other than that, UNH, I was double dipping in UNH. I know we got that pop. I think a lot of us was able to capture some of that long opportunity off that pop, but I exited off after we got that initial rebound on UNH, and then I went short on it. So, I'm sorry, I went long. Let me double check this position. Let me double check the initial position. So we had actually, never mind. We have 442 of credit on it. So we'll sit in that one. That one's kind of break even right now, but I mean, we really made up most of the gains just from today. And not much is really going on in UNH. SPY, this position's cooked. I've already accepted it. I know. 24 days, maybe something will happen. Got a short call spread on there, $5 wide, $1.73 in credit. A man's got to pray. QQQ, this one's worked out a little bit better. This was one of the only positions that I was really looking forward to over the weekend. I know I saw the futures open up on Monday, so it was no surprise that the market was going to gap up into today. Didn't expect a continued rally to the upside, but I'll take it. It's going to finance that SPY position a little bit there, so things are sitting pretty there. 24 days left. We got Nvidia. Nvidia was one that I had on for risk of the week. It's been about, I think, 2 weeks now. It was, I think, last week I put on the gold position, and then the week before that I put on the Nvidia. So still holding Nvidia, got 24 days on that. Not much has happened in there, but also, you know, I could use a little bit of a downside move in there. The gold position, I ended up taking off like shortly after we got off stream last Thursday. That was one where I had a short position on the market and then I had a short position on gold, and it just felt like such a conflict of interest there for me. So I ended up closing both positions. And then gold ended up spiking even more. So I'm kind of glad in hindsight that I took it off, but I believe gold is down a little bit more now, but I don't know if I would have been comfortable sitting in that drawdown whenever gold did rip to the upside. And gold was one that was that has a little bit of a higher point multiplier than something like NASDAQ. So I was a little bit more trigger happy in terms of the exit on something like gold and managing that position. So there's the update on that one. And then we got the Disney position fully break even on that. So we'll see how these ones work out, but that's the update right there.
Yeah, I recall seeing that move on gold, and I was concerned about your position. So happy to hear you bail yourself out.
Yeah, I think it was a micro gold position. I think it was.
Yeah, MGC.
Let me see. I paper handed this one. I can't even lie. Let me see if I can find.
Now you said I have a conflict of interest. I'm just gonna get uninterested. I'm gonna get all of it. I'm not gonna pick a side. No. Get rid of both of these things.
Honestly, though, in the market, it's just, you know what? Yeah, I'll sit on the sidelines for this. I'm not even gonna pick a side. That is so funny though. That is like just taking the neutral position there. Like, I'm okay if this thing runs without me, but I'm also okay.
Well, yeah, I just think the dichotomy between the aggression to be like, yeah, I'm gonna do this. I'm gonna get long. Yeah, we're gonna go both ways here. This is gonna work out somehow. And then you're like, I'm scared. It's
literally.
It's awesome. So I mean, it's good. It's good risk management. I'm not hacking on you. It's just
I hear you. But I mean, the market could have definitely dumped, and then I probably would have been like, okay, like maybe you should give the trade some wiggle room. I know I probably would have said that if it did dump. But right here, it kind of shows I did enter that MGC, so that micro gold. I entered that on 5:20 at 4 o'clock, so about 2 minutes after the bell, and then I ended up getting out of that literally about two and a half hours later at 6:31 p.m. because I was like, you know what, I don't think I'm about that life yet, but I'll definitely keep an eye on gold. This will definitely be popped up in another risk of the week. So anybody else trading gold out there, don't worry. I'm gonna hop back in there with you guys. Just give me a little bit of time. So we got Disney in the meantime.
Yeah, I like it. Disney, yeah, fun way to keep occupied. Yeah, I haven't been super active myself. I'm trying to think. Yeah, the only two moves I made today were picking up the Apple, adding a little more to my QCOM position. I have some Goldman Sachs shares that are just pissing me off. That just doesn't ever go anywhere. So that's been a mounting frustration. But other than that, portfolio pretty much remains as it is. Still got my Rivian loaded. Got some Google that's been printing for me. Google finally making a little bit of a run. I really needed over 170, and we've made that move. So happy with that. And then I don't even really have anything that's in particular need of management right now. Just kind of hanging out. And I mean, as you said, just sitting on the sidelines a little bit, preserving some capital, and waiting for the next volatility event, picking up some shares here at the bottom again as the discounts present themselves.
No, I hear you. I'm really waiting for something to happen in the market. I mean, again, the market doesn't move based off of how we feel or our emotions, but I mean, the fact that the market rallied all the way back up to the highs after selling off just for a few days, after the insane rally we've seen since, beginning of April, I'm curious about another short at these highs. So if we poke to new highs, I'm going to be forced to sell another call spread. So I'm going to be getting on more short deltas if we rip to these highs.
And, it could be interesting. It looks like these EU trade talks the gears might be turning a little bit on that front as well. So that's something that's going to be interesting to monitor. There was, I believe, a longer pause issued today, and some comments from Trump that they had good discussions. That's something interesting there. Obviously, all the China deals are interesting. I mean, I kind of feel like we're just in this odd waiting period. It's like this strange fake normalcy. We know these things are looming, but the market is just churning as though nothing is going on. And it makes it very difficult to think about any trades in longer than like a 30-day context, really, unless I'm thinking about longer than 365 days, in which case I think everything would get washed out anyway. But yeah, it's really interesting, this little waiting, breathing period that we're in, and I don't know how it's going to end. It's interesting.
Yeah, no, I feel like the coin flips so quickly. Like, I've even found myself putting on a long call spread, and then in the same underlying putting on a short call, and like looking to capitalize on both of those positions because the sentiment is switching, at the snap of a finger. We were selling off, and then now we're right back to those highs. So it's like things just, are volatile, right? Are back at positions from days before. So, Bob, looking a little choppy here. I haven't really been trading any of the Chinese stocks, but I think you picked one of these for one of the risks of the week not too long ago, if I'm not mistaken.
Yeah, I did. I was short Baba into their earnings call. I'm not sure which of the gaps that would be on this chart, but they did take a nice little gap down, and I think I was out the next day or the day after. I don't know that I let that one. No, I did let that one run too long. I was getting greedy and letting that one run to max profit, and it got so deep in the money that one of my top the top call got exercised, and it was a whole funny thing. Had to dip out because I got exercised on being that deep in the money, but it happens. No need to panic. It didn't change my cost basis at all. I didn't lose anything. I just wound up with 1,000 shares or 100 shares I didn't ask for, so politely exited those and took my profits anyway, but it was a funny experience.
No, I hear you. Kind of taking a little bit of a look at oil. Now, you don't do anything in the oil market, do you? I know it's a volatile one. Things get hot quick over here.
I'm allergic to oil. Not only is
I'm allergic to oil.
The volatility actually draws me to it, but it's the fact that it moves so independently from the rest of the market. Like, to trade oil, I almost feel like would be learning how to trade like Forex or crypto. Like, it's like this whole other thing that you have to be keeping track of all the time, and it's not necessarily correlated with the market in any broad capacity. And it's so news based. And yeah, every time I think about trading oil, I just think news could break literally any time that just rattles this entire industry. Any time in this 3-day contract, trading oil all the time feels the way that trading everything does right now with this tariff thing.
I was literally just going to say that after you were done. I was like, yeah.
It's like on any given day, all of a sudden some news could break and my position could be totally derailed by causes that are no fault of my own, and it's always scared me off for that reason. I respect people who trade oil for that reason, because there's like, nth level thinking going on. You got to be getting deep into the weeds.
No, 100%. I know sometimes I would like to use USO as a vehicle to get some exposure to oil, but we'll see what's going on in oil. I know another one has been a little while since we looked at is steel. It's a cheaper underlying, been going absolutely ham today. Was trading at around 40 points just a couple days ago, and now trading at about 53. So, 10, 13 points in just a couple of days.
They're being acquired by Nippon Steel, right? U.S. Steel that's the whole thing.
Well, what's interesting too, it's funny I'm not in this move to the upside when there were plenty of other times where the deals didn't go through, and I happen to be sitting in that position twice while we're live, and the deal doesn't go through and it tanks on me, and I'm forced to cut the position and manage it. Now the deal goes through, I'm not in the position because I'm taking some time off of steel, and we rip to the upside. That's usually how it works out, but happy for anybody else that's in steel right now.
Yeah, they paid $55 a share for the acquisition, so we're racing to price in $55 a share here.
Yeah, 100%. So we'll see if we get in here. Decent IV rank. Nothing in the way. Premium's really not looking too hot. This is something that I would definitely go naked in if I did anything, despite all the volatility. Because if you hedge in there, you're really not going to walk away with much. Other than that, though, we'll see what we get for the rest of the week. I'm going to keep an eye on these positions. If the market keeps on rallying, it's going to force me to get on some more short deltas. So the market is really teasing those all-time highs.
It is. Yeah, we just keep pushing higher. I feel like we'll catch it here eventually. I mean, it's just even this little sell-off that we just had, it's over now. We're just back to ripping as though nothing's going on and no one understands. And yeah, it's very odd, but I wouldn't be surprised if we touch all-time highs again before we come back down. I don't want to say
take out these highs. If we were to take out these highs and then pull from there, that would be probably one of the dirtiest moves I've ever seen in the market if that scenario were to play out. So all-time highs, we usually get a lot of buying at all-time highs, and we usually had higher. That's what the data says. So if we don't get that, it'll be interesting to see how things play out. But we're kind of teasing those levels. But other than that,
yeah, you do. You do certainly get that sort of psychological resistance going around all-time highs. And I'll say too, I love trading psychological resistance levels. That's a fun one. If a stock, especially 100, I don't know why, but 100 more so than 1,000. If a stock is nearing 100 and has never touched 100 before, holy cow, 100 will be the hardest resistance in the world. You can find these really nice little $2 channels and make some money that way. But yeah, I don't know. I mean, it's like, I don't even know if it would necessarily be a psychological resistance and then break of resistance and make higher highs sort of situation. It's just, it would sometime in that process, there be sufficient enough news, which seems to come once a week now, that we get knocked down for a few days. And then are we able to, do it again? Because it is kind of hard to push through that level initially. So the more we have to test, the less likely it seems it'll happen. I don't know. It's interesting. It's like a sport. Keeping up with all this is
no,
like
it is. I mean, we'll see what happens. I just think like if I was a massive bank or a massive institution, I have these massive orders I need to fill in the market. And if for whatever reason I wanted to get short, very hypothetical scenario, but excuse me, for whatever reason, I need a ton of liquidity, I'm probably going to look for that all-time high because, probably a lot of transactions going on at that level. And if I was just big money and I needed to position myself to the downside, I might take a peek at those highs. But anyways, we'll see what we get. It's always fun to speculate, but we'll manage our positions. Anything else though? We're coming to a close here. Anything else before we hop out of here today?
Yeah, no, nothing else to add. I'm gonna head to the airport and be happy to be back in the office on Thursday doing this with you.
Yeah, 100%. But safe travels. Hope things work out really well for you, and we'll see what we get for the rest of the week. We will be back here on Thursday at 4:30 Central Time, so make sure you swing back around. We'll update these positions, get into the new segment, and things of the sort. Make sure we manage these positions. Be sure to stay tuned for more segments coming on next, and we'll catch you guys next time. Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Welcome in Tasty CEO Tom Sosnoff, also founded Thinkorswim. Some call him the godfather of retail options trading. Tom, it's good to have you on. How would you be reacting as a startup founder to this news?
I'd be really pissed.
Yeah, as you should be, brother. I'm glad you said it because I can't.
And this is how we think as traders. You're much better off, instead of trying to follow the trend or follow the fundamentals, you're much better off playing the role of a contrarian.
And what I really want to do today is kind of break it out of that box and make it what it really should be, which is about understanding and thinking about probabilistic, predictable outcomes, about quantitative strategies. True financial literacy is about taking risk.
There's a very thin line between opportunity and risk, but where there's the most noise, there's the most opportunity.
The second you believe that somebody knows something and it's not you, then you're dead.
Well, he's more public in his mentality.
I'm a believer. I believe that the world is good.
And I know that the world is not good. That questioning yourself and questioning yourself in dialogue with someone you respect is both pleasant and sometimes extremely insightful and useful sometimes.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Oh, yeah, it's Tuesday, May 27th, a little bit after 5 p.m. Central Time. The best time. You know what that means, everybody? It's time for The Price of Truth, a little podcast called The Price of Truth. It's Wednesday, everyone. Oh, my goodness, I just said Tuesday. It's Tuesday, everyone. You know what that means? It means we got our extra special guest here, head of Global Macro here at Tasty Live, Mr. Ilya Spivak. Ilya, how are you, my friend?
Good. Just spent the weekend up the coast here in the wonderful area of Santa Cruz and Aptos, and it's gorgeous over there. Chased the kids up and down the beach for a few days.
Yeah.
And come to find out, the tariff scare is not a thing.
Did you do the Rocky Supercut where you were running up and down the beach? You guys are all racing each other?
My son got himself a little bit over wet by the oncoming surf and cut the whole thing short nice and quick. It was like, listen, my Wu-Tang shirt is wet and now we have to leave here.
Very well. That sounds like fun, man. We need to take a little vacation. We just keep going to different parts of Indonesia. I realized. Went to Bali, went to Batam.
Bali's fantastic.
Went to Bintan. It is incredible. I wish if you could go to one place in the world outside of San Francisco. The weird thing is, if I said anywhere in the world, you would probably pick San Francisco. That's how wild San Francisco.
I love San Francisco. Yes,
I know. So if you could go anywhere in the world and live, where would it be? Pick one place.
If it wasn't San Francisco, it would probably be New York, I think.
What the hell is wrong with you? What is wrong with you?
I'm from Moscow, man. I'm from the urban jungle.
That's what I like. What the hell is wrong with
That's
you?
what I like. It would have been, if you'd asked me that question, let's say 5, maybe 10 years ago, the answer might have been Hong Kong. But because I love Hong Kong. I love Singapore too, actually. But to live if it couldn't be San Francisco, it probably would have to be New York.
Bro, no wonder you guys vote the way that you do. You just keep creating these urban hellscapes everywhere.
I love me an urban hellscape.
Yeah, you're voting, you're manifesting your favorite aspects of life into reality. Everyone else is going, hey, we got to do something about this. And you're like, what are you guys talking about? This is beautiful. I think mine would be either Bali or Barcelona.
Bali's very nice.
I like
Bali a lot.
Yeah, but I like to go to there's a beach part. I think it's called Seminyak, something like that. That's where all the young people go and they go party. No, I get out to the secluded part where nobody can find me. You know, if I go missing, nobody's gonna know where I am. I like that type of seclusion. Or Barcelona was just like, I was blown away by that city. Sports, architecture, art, great food, Mediterranean Sea. I was like, you have everything.
I should put on my list while we're on this subject both Melbourne and Sydney, which are both fantastic. And I would probably err in the direction of Melbourne, though I've spent more time in Sydney, oddly enough. Melbourne feels more San Francisco-ish. It's sort of on the San Francisco Vancouver spectrum.
That's how you measure a place.
Yeah, I'm like, how close to San Francisco is this?
And that, everybody, is the cold open. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be part of the chat that's in the middle of your screen, there's only one place to do it, and that's on Tasty Live's YouTube channel. Head on over there, subscribe to the channel so that your thoughts, both appropriate and otherwise, will be featured in the middle of this stream. Do us a favor, get those phalanges and metacarpals pumping, bash your skull into the keyboard if you have to create random ass characters and spoof the Google algorithm into putting us in front of as many people as possible. Ilya Spivak, S&P 500 up more than 100 points today, 5,921, up 2%. The NASDAQ did even more damage to the upside, up 2.4%. The Dow Jones up 1.75%, and the Russell up 2.5%. My good friend, what gives?
Yeah, it's a fun little thing to start the week on. Now, obviously, you can start with your usual, and since I have a bearish inclination, you can sort of rattle off the typical bearish talking points. But I think what's much more interesting.
This is all just a 50% tariff threat, and then I was just kidding. Is that so? So the market took out, it discounted something at the end of last week. Now you got to put it back in. And that's basically what today is.
It sort of feels that way. Chris brought up earlier today that the Conference Board consumer confidence numbers were meaningfully better and unclenched a little. They still look god-awful relative to where consumer confidence was by that measure last year, but certainly well off the lows that we saw earlier this year. And I thought that was perhaps something. But what's interesting
how surprised were you when you saw? I bet your jaw just dropped.
The consumer confidence numbers. Not that surprised. It was more like
you've been on this whole kick that people the tariffs have freaked everybody out and people aren't going to spend and they're spooked and it's just a matter of time before
and these numbers are still recessionary. Of course, these numbers are still recessionary. There's no question. There's still terrible numbers, again, relative to last year. But it was a better than expected number. And some of the internals did look better. I mean, okay. I thought the more interesting thing here in this data was this data, and they very helpfully write this in the report. They say that something like 50% of the response in this survey came after the May 12th delay of the tariffs on China. And the end point for the survey is May 19th. So there's some time for that news to kind of sink in.
So meaning as good as these numbers were, the good news hadn't even been priced in yet into these numbers. That's basically what
no, apparently it was, right? Because the China news is the 12th, the survey end is the 19th, and the Conference Board is telling you that half of all responses came after the 12th. This is significantly skewed in the direction of the China tariffs are already on pause. The president is saying on social media that there's been a total reset. I mean, that's obviously encouraging. There's no question there. The much more hysterical University of Michigan consumer confidence numbers, it's a different survey window. It ends on the 13th. So there's really no space for all of this to kind of settle there yet. The 12th is captured, but it's mostly not in the data. And we'll see how that's revised at the end of this week. But this is really the dance here. I look at these numbers today. I look at the sort of tempest in a teapot thing that the president stirred, then unstirred between Friday and the weekend with the European Union. And I go, okay, well, the European Union thing shouldn't matter. That doesn't mean it doesn't as far as price action. But if you look at kind of the economic bottom line, we're back to where we were on Thursday of last week, which is to say that there is a July 9th deadline. We're going to see what happens with the pause on reciprocal tariffs then. And in the meantime, what the real story is, as far as I'm concerned, with these tariffs, it's not these headlines. It's not this constant stirring up of the news cycle. It is interesting that the stirring up is getting significantly shorter. So the markets are starting perhaps to reduce the half-life of these things and to start to get more immune to the ruckus.
That should freak everybody out, by the way.
Yes, it should.
Because the claims that have to come have to get bigger and scarier in order to have a market moving impact. So if you have a president who wants to make material moves in markets, it should freak you out that at the beginning of this administration, you're getting these 60% reciprocal tariff claims. That's enough to move the markets. And now 50% against the EU was good for a couple of percent, and that's about it. It should freak you out that the vol dampening that's happening is just going to mean that your this president's going to have to make bigger and bigger claims should he want to make a material market impact.
Yes. So that's, yes, of course, agreed. And it should also tell you that the markets eventually are going to stop listening to all of the noise and focus on what I think is the real story, which is that the U.S. tariff facing the world, on average, has gone from 2 to 10%. It's been baked in that way into this deal with the UK that we got. It's been baked that way into the conversations that we've heard with China, with Japan. They seem to want to stick with that number. And that's a 5-fold increase in the cost of imports, which is very, very tough.
What would you say to somebody? What would you say to somebody
eventually?
What would you say to somebody that says the market can handle it? Just like when we went off of like this very low zero bound in interest rates, we jumped to 5.25. People think, oh, the end of the world is coming. The market can't handle these rates, and the market handled the rates. People think, okay, we had an average tariff rate of 2%. Now it's 10%. End of the world is coming. what would you say to somebody that says the market can stomach this?
Maybe it can. I just don't think we know the answer yet. I don't think it's impossible, certainly. I don't think you can rub your crystal ball and say this will definitely blah, 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 blah. Nobody knows. All we're doing is we're weighing probabilities, right? We can understand why when outlays on debt servicing don't go down after, or don't go up, rather, from U.S. corporates after a rate hike cycle, a massive, historic rate hike cycle. We can see why that rate hike cycle doesn't bite. Because the object is, well, how would it bite? It would bite by making credit more expensive. But because so much borrowing and so much inventory of cash was accumulated during basically zero rates during COVID, it didn't bite. Or it hasn't been something that we've seen yet. Now, in fairness, there's a giant debt redemption cliff this year and next year as all of that money comes up for refi. So have we already discounted the rate hike cycle, or is it just delayed because of post-COVID weirdness and is just a consequence, yet another nth consequence of the dramatic COVID response and all of its many kind of ripple effects?
So you still think we're going to see a macro impact from a rate change from a few years ago?
Yes.
Isn't it more likely with 30% of the S&P over levered into just a handful of companies that what would happen is just like we have a K-shaped economy in the real world where certain levels of individuals, their balance sheets are terrific, they're feeling fine, and then other individuals are barely scraping by. Isn't it possible that just those smaller companies or those more over-leveraged companies, they just get swallowed up by the companies that have great balance sheets? And what you end up seeing is more bankruptcies, more synergy, bigger corporations end up swallowing the assets of those companies that have less pristine balance sheets, but that doesn't necessarily manifest itself in any negative equity pressure. Isn't that possible? And most likely?
I don't think it's most likely. I think that what you're describing certainly is the paradigm that we've been watching, let's say, for the past 30, 40 years.
Okay.
There's a really good book, and I say it's a really good book despite the fact that I basically disagree with its conclusions. I think it's written well, and I think it summarizes well. The book is by Ruchir Sharma. It's called "What Went Wrong with Capitalism," and I think you'd probably think that it's spot on as far as its conclusions, because it mainly says that runaway debt, as enabled by an easy central bank, is really the main problem with everything. And I don't quite see it that way, but it's
I don't think the easy money is the problem. I think it's a giant cabal. I think that's the problem. But that's
well. So you'd find a lot here to agree with, more so than me. But I like to read all perspectives, and so while I don't necessarily agree with the conclusions, I think a lot of the discussion here about what has happened with the concentration of economic power and the concentration of economic wealth and consolidation of industry after industry after industry into ever larger companies. That's certainly the case. That's certainly part of what we've seen as the way that markets have digested a lot of this stuff. There's a crisis, rates are low, weak hands fail, big, large, too big to fail conglomerates swallow, become bigger, become larger, become more too big to fail, as it were. But shareholder value is ostensibly maximized, and so the market goes, okay, fine. As long as the Fed keeps credit available and the government can then borrow with impunity to backstop all of this were it ever to hit a wall, let's get there and see, but who knows when we'll get there, if ever. So far, it's working. So that would kind of be the regular response. I don't think we're in a regular response world anymore. And I think really the fact that Donald Trump is president again, the fact that we have the level of discontent and that he's accurately diagnosing the issues. I mean, we've said this on this show many, many times. The president seems to be very good at identifying what the electorate is actually upset at. It's just we have I certainly do have disagreements with the approach to what to do about those things. But there's a reason why the first Trump administration takes a very hard line with China, say, and puts a bunch of tariffs out there. And then the supposed opposition comes in and not only doesn't lower them back, but actually increases them and compounds it. So there seems to be a clear kind of consensus emerging on what the voters want. They want to confront China, that they want to address all of these things. And so if this administration becomes another administration, and if this episode becomes another episode where the core things aren't dealt with, anecdotally, I think this is how you end up with people going, I voted for Obama 2 times and then for Trump.
And all I got was this lousy T-shirt.
because people want the transformational policy to address the thing, and what they're getting is people with old model thinking saying, well, our standard answer is X, and the other side going, well, our standard answer is Y, and those have been the standard answers since basically the late 80s, early 90s. But neither of them are for the moment. This moment requires a third answer. Like Reagan was a third answer for the problem of his day. Like FDR was a third answer, a radical shift for the policies of his day. So I think to kind of talk about, once again, all those cyclicality books we talked about, Friedman's and The Fourth Turning and Dalio and all of this, there seems to be a desire for something third. And
they're not,
I don't think it's going to work this time.
No, they're not going to get it. And I think, like, I've been thinking about this a lot lately, and I thought this was the biggest risk once Trump was elected. As I said, I wonder what happens after these 4 years when people are ultimately disappointed with the outcome.
Yeah.
It is possible that, things go really, really well for, a certain group of people who are being promised a lot. It is possible. I think it's highly unlikely given the incentive structures of the system. So I thought to myself, if in the event this fails to produce a meaningful material difference for the electorate who put so much hope into this 4 years, what is the response? Is it like just complete apathy? I tried this side, I tried this side, I tried establishment, I tried anti-establishment, nothing is working. And you're either at that moment, you get like a complete apathy from the people, or you get anger. And I'm really, really curious. I'm hoping for the best outcomes, but I'm very curious in the case of failure, what happens to the people? Do they get apathetic, sort of grow more economically nihilist, or do they get pissed off?
The optimistic
neither of those are good outcomes in my point of view.
Right. So the optimistic perspective from someone like a George Friedman, and he makes a very compelling argument. One of many of these cyclically minded thinkers that think that 2025, 2026 is something of a cyclical 50-year breaking point in the U.S. institutional cycle, and this is about time for us to have this. That at the end of each cycle and the beginning of a new one, there has to be a failed presidency of the old guard that basically then slaughters all the sacred cows. And the people are finally ready to vote for something third and other. And it comes from one of the mainstream parties, either this or that, but you get a figure like a Reagan that basically says, listen, we have to do something completely different. Or FDR, we have to do something completely different. And sets the paradigm for the next kind of iteration of the cycle. And interestingly, George Friedman writes this before the last election. He actually expects that Biden is followed by a Democrat who then has the failed administration, and then there is this shift.
Trump is a Democrat. Trump is a Democrat.
I mean, ultimately, I don't think it really matters.
He has the same set of policies a Democrat in the 90s would have had, like a centrist Democrat in the 90s would have had. And just today, that means you're a Republican. that's just how he thinks.
The style is different, obviously.
Yeah. All right. Let's go and let's get back to the markets for just a second. Well, Nvidia tomorrow. Is this the ultimate make or break moment? I love the fact that markets crept their way up to 6,000 going into this event. Like it's right at the over underline. It's a place you don't necessarily want. But if they blow it out, and for whatever reason I don't know what their expected move is. I should check it right now. But if they're trading 150, it's only $9. What? Mm-hmm. Why is it so cheap? You can't sell that. Anyways, seriously, $9? This is either the market is so complacent about this that I almost want to bet against it. Or you bet the massive downside because it'll scare everybody. I can't believe you only have a $9 expected move. Anyways, what's your point of view on Nvidia going into tomorrow?
So let's go back to kind of late 2022, early 2023. You start to get these massive earnings beats for Nvidia as the AI thing really starts to take off. Like 18% earnings beat in the first quarter of 23, 30% in the second quarter of 23, 18% in the third quarter of 23. Like it's double digits until you get into last year. And last year, it starts to slow considerably, as though the markets are kind of benchmarking and getting acclimated to what is normal for Nvidia. And so last year, first quarter, 9% beat, second quarter, 5%, third quarter, a little bit better, 8%, fourth quarter, 4.9%. So the magnitude of surprise has significantly come down last year versus the year before. This is, I think, more than it is a corporate earnings report. At this point, this is like a sentiment indicator. Will they report something that is chipper enough that the markets go, ooh, NASDAQ can go up now? Or won't it? And if Nvidia comes out and let's say, chances are they beat again. Companies are not in the business of guiding such that they can't overshoot. This is a big strategic point, obviously. Companies underpromise and overdeliver, or they try to underpromise and overdeliver. And of course, part of the overdeliver is they underpromise. So chances are they overshoot, but by how much? And what's the guidance? Now, we know the guidance is going to be awful because why in the world would you come out there with all this tariff stuff and be oh, this doesn't matter. A ton of our business is in China, but that's okay. This is all going to be fine. No, No. Because you have every reason to guide negative, and the markets know this, because then if something goes wrong, you go and you blame the tariffs and you're okay. Whereas if something goes right, then you're a hero. You did that. So I think they'll guide awful. It'll beat by a smaller margin, maybe somewhere in the vicinity of like 2-3%. And then the question becomes, is that good enough? And this is where I think the point that we're in is so auspicious. If you look at where either NASDAQ or the S&P, it doesn't really matter. You're back to the recent swing high. So basically, you've done the kind of okey doke on the, oh my God, European Union tariffs. Never mind. And you're back to where you were, but you're not higher, you're not breaking out. You just got spooked. It was a long weekend. You came back. Okay, nothing happened. It's Thursday last week, as far as the market is concerned. Okay. But what's actually occurring here? And have we finally gotten to the point where the negotiating tactic nature of all of these boy who cried wolf tactics finally digested? And are we finally going to get to a point where the market is going to go, okay, what's the actual value of risk here? Because right now we're jumping headline to headline.
Some people are jumping. I think like right now, there's still the way I see the world, it's like there's still a fair value, man, and there's just a vol around the fair value. And those headlines just make that the distribution a little bit wider, but we're still trading around a fair value. And the narrative, especially in our business, for people that are kind of making up stories to go along with the price change, it seems like it's super headline driven. I've never felt that way. I just felt the distribution got a little bit wider, but all these assets, they still have a fair value, and we're just trading around it. When it comes to Nvidia, it's kind of interesting that it's only $9 expected move, and the call skew is only like 2 cents. It's only like 2 pennies. So what would be the most interesting outcome here is Nvidia actually does not matter. That would be the most interesting outcome, that there aren't a ton of people just running out to buy upside calls into this event. Maybe it's too early. Maybe we'll see some of that tomorrow. But that would be the most interesting outcome, I think, that we make this into this gigantic Super Bowl of an event. Nvidia moves 1.5% in either direction, and we just move on. What's next? That would be the funniest outcome to me. And it seems like we could be setting up for that, or we're just too complacent. $9 is super cheap. I do not understand that. Let's go to bonds for a second.
That's the part of it that, and I think you've just explained it pretty much in line with how I'm thinking about it. As I look at it, it feels complacent.
Yeah.
Because when I look at it, I go, okay, you're happy that he meaning the president, and through him, the administration, is responsive to market discipline to some extent, is not married to tariffs for tariffs' sake, is trying to get something for the tariffs so he can lower them, is trying to build bigger free trade blocks, but on renegotiated terms and with methods that I personally think are untoward and don't help, but that's my opinion.
Mm-hmm.
That's my opinion is neither here nor there. The important thing is the president is very clearly saying, I am not Peter Navarro. I don't think that tariffs are a good unto themselves, and what we and he's not JD Vance, who thinks that the dollar's exorbitant privilege is a bad thing. Clearly, the president does not hold either of those views. He's using them as a pit bull might bare his teeth.
The thing you said is so important, and I think so many people got caught off sides because they want to try to judge. They care more about their opinion than trying to objectively navigate through this. You don't have to like the method. You don't have to think it's going to lead to a good outcome, but you have to, as best as you can, try to put yourself in the mind of the other player and read the bets and the cards that they're playing. And I think that got hard for some people.
It did.
A couple months ago. But I think what you said is really the most healthy way to think about this, which is here's my opinion on the matter, but also here's my objective read of what's happening at the card table. And as long as you can do those two things, you'll be okay. And we can debate over whether it's right, wrong, whatever. Let's have that discussion. But let's also understand that those are not the same. Those are not the same thing.
So, perfect. Yes, exactly right. Those are not the same thing. And I think the market is looking at the way he's behaving now and going, oh, we were afraid that he was crazy. Good news, he's not crazy.
Yeah, but I think
we may not agree with what he's doing or be put off by what he's doing, but he's not just going to go in there with blinders on and break the dollar and the treasury market and our trade relationships. There is a method to this that you may or may not agree with, but there is a method and there is a reaction function to what the markets then feed back.
Catan said, so far he's got a plane and a promised new hotel.
Well, that's right. And this is the key. When you get to the bottom line, the economic cost of this is something that the markets are asleep at the wheel about, in my opinion.
I don't think so. I don't think they are. I think at the very outset of this, they priced 10%. I think the fact that his reciprocal tariffs were so far away from that, the markets had to discount the possibility, a very different possible range. People freaked out over it. They over-rotated because they didn't see the card game as it is. They saw it as what they wanted to believe. I think the media didn't help by screaming chaos. It wasn't chaos. If you sort of understand the position that they're in, they later announced it, like Besson saying strategic uncertainty through game theory. If you explain what you're doing, it minimizes the effect of your methods. Again, doesn't matter if they're right or wrong methods, you agree with them or not. What the way they're trying to go about this, had they explained it up front, it actually minimizes their potential impact to create leverage. So they can't, but the media explains it as chaos, and it just you have to go, am I going to believe what the New York Times is telling me, or am I going to look at the card game and read it for what's going on? Bonds at 112 and 16 ticks, so 112.5. A little bit of a rally over the last couple of days. They look like they wanted a little basing pattern off 109. Are they giving us the okie doke here, Ilya, or do you think we're building some sort of sustainable bottom here, tradable bottom here in the bonds?
Now, obviously, I don't take talking my own book as anything that's or anybody else talking their own book as devaluing of the opinion, because if you're trading your opinions, well, then you must think that you're right. So you should be talking your own book if you're serious about what you're doing. Otherwise, you kind of have to ask the question, like, if this is your opinion and you don't have it all, do you know that you're wrong, or do you just not have confidence in what you're saying? What's going on? So, I mean, I have bonds long. So, yes, I think that they're basic. In my mind, I am looking for a kind of cross-asset mix where gold and bonds go up, stocks and the dollar go down.
Gold and bonds go up. Dollar and what goes down?
Stocks go down.
Explain to me. I sort of I have bonds going up, gold going down. There's sort of this like the market getting a little bit more confident in just U.S. assets. I'm playing it that way. Tell me why you think bonds and gold go up. That's a scary world you're pricing.
I think it's actually less scary than you think, or than you might think.
Explain.
I think if you were looking for the bonds to go down with stocks and the dollar, as we saw in April, then you're sort of in a hair on fire. Oh my God, this is a currency crisis.
Yeah, it's true.
They're trying to force exit the global financial system when they're the bedrock of the global financial system. So we've made the point on this show. It's like if the foundation of your house dug a tunnel and left, and the rest of the house was like, wait, what am I supposed to stand on then? So that's sort of that world. And we're not there, clearly. Because, again, I think the markets have come to the realization, and this is what sort of the surge in stocks in my mind is all about, is, oh, good, this isn't what we thought it was in a worst case, holy moly, hair on fire kind of way. What this is, in my mind, is regular recession. Just not 08, not COVID, just a regular business cycle. And frankly, we should be getting more used to that. Because in this new, more deglobalized world, in this new world we're building where there's less emphasis on internationalist cooperation, we're degrading the United Nations, we're degrading the WTO, we're degrading all sorts of multilateral institutions, and instead are saying, listen, the reality is we run this thing, so what we say just goes. Might is right, it is what it is. And we'll see how that ultimately occurs. And in some ways, China kind of set the table for this kind of thing. Because the idealism of admitting them into the WTO didn't really pan out. So now we get to a place where I think you're going to have these types of things more often, as you used to, before the sort of what Greenspan called the Great Moderation. Before that. So now I think you might be getting ready for, when you increase tariffs fivefold, that hits consumption, it hits investment, it ultimately hurts. When you do it in the year when you have to refi COVID money, it hurts more. So the business cycle is going to get hurt. So you're going to have rate cuts. They're probably going to have to be more aggressive than what the market now anticipates, because apparently it's all roses and unicorns out here. And so with that, you get a weaker dollar, you get lower yields, you get lower expectations for corporate performance. Gold and bonds go up because yields are down. Interestingly, I think that probably happens as the run-up to those greater rate cuts is in the kind of speculative phase. Once they start, markets should already have that discounted. So that should be near the top on bonds, near the top or near the bottom on the dollar. You should kind of be through the speculative stage where the markets kind of adjust to this world view. But that's sort of what I envision.
So if you could go back in time, right? If you can go back in time after Fed jacks rates, and then you look at the size of the bills that the Biden administration was passing, that Manchin was trying to stand in, but ultimately folded like a cheap suit for some energy subsidies for his state.
Politics is politics.
Politics is politics.
Politics is victorious now and forever.
So if you go back in time and you could mentally quantify just how big those spends were and how
they were going to sort of force the economy just through those higher rates. Why do you not look at the budget? Why do you not look at the budget that the Trump administration just put out, the House passed, and say to yourself, holy shit, like they're going to run this thing hot? How do you not look at that gigantic bill?
They do seem like they want to run it hot.
So then why do you see a world of like normal, like a quiet, serene recession, and not these guys are going to run a hot economy, and the bonds are responding to that, currency's responding to that, and that's their goal here. It was almost like they had two paths, right? There was one path where you get Doge in, your happy path is you find a $500 billion to $1 trillion. Your happy path is the negotiations go well with China. You're able to get these terms as you want them. Sad path is, oh shit, we only found $160 billion. That didn't really work out too well, but maybe Elon got some Social Security data. We can do something with that later. And then, and these trade negotiations are kind of meh. So our out here, we got to run this thing hot. And that was always like the out. If this doesn't work, we always have what we always do, and we'll run it hot and inflate away the debt. Why do you not see that as what's happening?
Because I think what the Fed, number one, that's not what the markets see happening. That's the beginning of why I don't see it that way. And I think when you look in particular at market-based inflation expectations, obviously when you look at consumer-based inflation expectations, they're on the order of the hysterical. Inflation is not going back to 7%. Stop it. Like that would be nuts. That would be like, we're going to run it hot. And the Fed has said, you know what? Not my circus, not my monkeys, to borrow the Polish proverb. We're just going to let this thing go. You want this issue? You have it. And do nothing. And justify it by saying, well, eventually the tariffs, bad for growth, blah, blah, blah. And then, then you really run hot. But 7% is aggressive. Still. So let's leave that aside. Actual market-based inflation expectations, the break-even rates that are priced into bond markets. It's a very interesting dynamic you see here this year. Mid-February, stocks, the 5-year and the 10-year break-even start falling together because it's a growth scare, because the PMIs come out and they're scary, and the consumer confidence numbers come out and they're scary, and and all of them say consumers and businesses don't like the tariffs. There's a lot of uncertainty. They feel like they can't make the decisions that they want to make, so they're pulling back spending. It's in there. You can go read it. That's what all of this stuff says. And the market responds because the PMIs go from some of the strongest growth that signaled since, let's call it, second half of 21, early 22, to basically no growth at all. Standstill within just January, February going into March. And markets go, oh, this is not good. Whatever we might have thought about the tariffs, and clearly we weren't afraid of them conceptually, we've talked about that before, but this is not good. Because if whatever is happening is scaring consumers and businesses, doesn't matter what we think. If they retrench on economic activity, that's what the reality is. Full stop. So break-evens and stocks fall together. They bottom together in early April. Stocks obviously rebound with gusto. Break-evens don't. They're anchored still. They're down still. They're up a little off their kind of full-on panic mode, but they're still down, and by a lot. So you very clearly get the signal from the bond market that whatever inflationary impact the tariffs might have, the degrading impact on demand will be greater. And the net result of all this will be disinflation. And that's a growth scare. The markets are telling you that the business cycle is due for weakness, downwind. Let's say with like a 3 to 5 year window. If you, again, look at the maturities. But so that's one thing. The other thing is, of course, the Fed is not going to sit idly by. If they run it hot, the Fed will hike. And they've been telling you that since March. And the third thing is there's no telling what this bill is beyond extending tax cuts that are already there. And in fact, diluting them a little, maybe. So
I went through it, man. I was shocked. I was shocked at what they're spending money on.
Well, but the Senate is not gonna okay this. We've seen that already.
Maybe, but I think I don't know that I wouldn't bet that they like cut it in half. I doubt that. I think they'll probably like I think sometimes in these negotiations, here's what happens. You throw in the cuts to SNAP and Medicare so people can get all pissed off about it. And then what the Senate will do is they'll come in and they'll remove those cuts. They look like heroes, even though those things were so minuscule relative to the whole package. And then they get to look like they did something, and you really didn't change the scope of the bill at all. I think you see something like that. But I think to your earlier point, I see the same numbers as you. I just interpret them slightly different. I think the inflation number, it's a model. It's not reality. And so it misses. So when people think about inflation, they're thinking about the cost of milk and eggs and butter and meat. You know, that's what they think inflation is. In reality, that's almost doesn't matter. It almost really doesn't matter to that number. And what matters the most in that number is housing. It's a third of the weighting of that number. And so mostly when you think about that inflation number, you're mostly thinking to yourself, what's going to happen to the housing market? And you can have a world where, like what we're seeing, I think right now, we're in the early stages of softening housing markets in places that they just ran too hot in a time when the Fed was buying all this mortgage paper. I think so you could get downward pressure on the inflation number. At the same time, the government is printing tons of money. So you can have monetary inflation. You can have things can be devaluing. At the same time, you have sort of this base effect or downward pressure that's happening in the housing market. It looks like things are normal. It looks like things are sort of constant. But in reality, you've got sort of this weird chaos happening around you where some stuff at the grocery store is going to be a little bit more expensive. You've got weird things happening in the housing market. So I think I see a world where you can have a bit of disinflation and monetary inflation. And I don't know if that's a crazy thought. It's an impossible thought. What do you think, Ilya?
I mean, housing is obviously very important. If you look at the PCE numbers, which is what the Fed looks at, the contribution of housing to those numbers is somewhere on the order of 30%, in the sense that housing accounted for about 0.07 percentage points of the 2.3% rise in overall inflation in March. Core goods is about 70%. So it accounted for 1.66 percentage points. And some of it is housing services and related things, so there's some overlap there. But to me, the biggest thing looking at the modeling, if you will, to sort of borrow your parlance, is still core services, and that's basically consumer demand. It's consumption. Because if you see what's been going on in the U.S. economy really since, let's call it 2021, middle of the year there and onward, the main story has been that we have a booming U.S. service sector. Most services demand is fed by domestic firms. And so the U.S. is kind of this island of buoyant services activity. Meanwhile, Europe is anemic, China is anemic, everybody else is kind of still attempting to find their footing for a lasting something after COVID. But the U.S. had this really booming service sector, mainly powered by consumption from domestic firms last year, which has now significantly slowed because those consumers have become more skittish. And you can see in the first quarter the weakest consumption in almost 2 years. The break-even story in the bond market that I'm looking at isn't a model. What it is the actual price implied path for inflation expectations based on the buying and selling occurring in the bond market. So it's actual liquidity. This is not a model. This is market sentiment as backed with risk capital. So people are, as it were, putting their money where their mouth is. And what that's telling you is that inflation expectations are not rebounding. They are not coming back to where they were even at the start of this year, though stocks have mostly come all the way back. They've erased something like 80% of the sell-off at this point. The big one since the mid-February top. So when you look at all of this together, you kind of get the sense that, okay, the main issue here is, does the U.S. economy hold up? Because if it doesn't, then you have a global recession almost any way you slice it, because there's no backup. There is no robust Europe. There is no robust China. You need the U.S. to hold up. For that, you need the U.S. consumer to hold up. If the U.S. consumer does hold up, well, then you're probably okay. But the bond market is telling you that the answer is that's not the path of least resistance. And that you had this very close lockstep relationship between these break-even rates and stocks up until April, where they diverged, where stocks ran off and inflation expectations didn't. To me, that seems to say the bond market knows that there is an economic downturn that's coming downwind, and stocks, in their endless speculative optimism, have veered away. And the readjustment is afoot. You just need the data to really start to tell you that it's occurring. And we'll see what happens with the revision of the consumer confidence numbers this week. We'll see what happens with the revision of the GDP data this week. If, for example, it's revised to show much weaker consumption, that'll be a thing. If it's revised this week to show stronger consumption, that'll be a thing. But I think the question now is, where's the real meat of the growth story? And will it actually reflect the optimism that stocks already show?
If I was listening to two people in an office and one of them was the bond market, one of them was the stock market, I would trust the bond market more than I would trust the stock market.
Me too.
However, there was that period end of 2022 to early 2023, where the bond market was telling you something ugly was coming in the real economy, and stocks were out celebrating, drunk and having a good time at the club, and who ended up being right. The stock market ended up being right, and the bond market sort of had to readjust to the reality of the economy later on. And I'll just put that out there as a cautionary tale.
Sure.
Every once in a while, I like to kick the hornet's nest with you, and I like to talk Bitcoin. Bitcoin at 109 and change. Coinbase being added to the S&P 500. We talked about that a little bit. Your boy over at MicroStrategy, which is Strategy Now, just buying billions upon billions of Bitcoin, and selling equity, selling the equity premium to fund it. Do you have any thoughts here at 109.5? Does any part of you starting to go, you know what? Maybe this thing's a little bit more real than I've given credit to in the last 16 years?
As we typically end up with at the start of this conversation, the question is, well, is it more real? Like it is what? Is it real as a speculative asset with genuine volume, and by the way, growing volume, and genuine increase in institutional acceptance as a speculative asset, as sort of yet another reflection of where money can be allocated with a risk profile and et cetera, et cetera? Yeah, I mean, it's obviously become more real on that score, and I wouldn't dismiss it. But is it something that is a challenger to government-issued monetary systems? No.
How can you say that when it's already, if $1 trillion is already in the market, that it came from somewhere, right?
Yeah,
so
$1 trillion is nothing.
It is a challenger to something because there's opportunity. That means taking away from investment elsewhere. So it is a challenger.
I don't necessarily think that's the case. I think that to assume the pie is fixed and investment over here means less investment over there, I don't think is an assumption I am making. I think the fact that we have economic growth means that the pie is growing. And we have a new...
That's still, just because the pie is growing doesn't mean, like, the money came from somewhere, Ilya. If it was not in this market, it would have to be somewhere else.
If the pie is growing, well, yes. If the pie is growing, and at the same time...
It doesn't matter if the pie is growing or not.
Of course it matters.
No, it doesn't.
Because the growth of the pie creates new money.
That doesn't matter.
And new money can be allocated or not allocated to this or that thing. And this thing, through first futures, then ETFs, through now a friendlier regulatory regime, it is now more mature than it was before. And there is more capital allocation in that direction because customers are interested, and it is increasingly becoming a financial asset like any other.
Do you think the interesting part?
I just don't think that it's a currency.
Okay, I'm not gonna. I think the frame that what's his name? Why can I forget his name?
Michael Saylor.
Michael Saylor. Thank you very much. I think he refers to it as digital property, and I kind of like that mental frame. I think I said 1 trillion. I think it's 2 trillion.
I don't get how it's digital property. Like, what is it that you own? What is what do you have a claim on?
You own a sat. You own you're stacking sats, baby.
you know, so if you told me, hey man, you get part ownership in the data center, that's digital property. You get you get to own a piece of cloud that you could then re-rent and generate income from. Okay, that's digital property. Which, by the way, would be very interesting to sell cloud capacity fractionally.
That's kind of what Ethereum is. You're sort of owning or investing in the network a bit. At least that's the way I've been explained.
Yeah, so I get that
by smarter people than I.
I get that. I can understand. Look, you're owning a piece, a tangible piece of the architecture that you can monetize yourself personally, the way you would if you bought a condo. You could live in it, but you could also rent it out and monetize it. I can understand that. What can you monetize other than conversion back to fiat for purchasing the thing you're meant to be replacing? What is it that you own with a Bitcoin type of asset? What kind of digital property have you bought? I don't know.
I'm trying to figure out whether to go down this rabbit hole with you in 20 minutes, given the other stuff I want to cover.
It's probably not worthwhile. I will say this. From a price action perspective,
is there a number? Is there a number where Ilya Spivak, Bitcoin gets to N number, where Ilya Spivak goes, I either I was wrong about this asset or I wish I would have bought some? Is there a number? Are we already there?
Probably not. The fact that was I wrong or wasn't I wrong? It's an interesting question because I don't think we know. Because again, I've never said it won't go up or it will crash. I just don't think it is what the maximalists claim it to be. And I'm not participating in it on that basis. Because actually, Bitcoin is an incredibly concentrated market. Most of Bitcoin is owned by a very tiny group of people. The idea that this is some sort of democratized instrument is
you could say the same thing about the S&P 500, though.
But that's neither here nor there. We're talking about this, and the pretension of this asset is that it's some sort of democratizing force, and it's owned by a very small group of these maximalist types, mostly, who believe it to be a thing that I don't think it is.
Yeah,
and if that's the logic of this market, I just don't want to participate because I don't buy the fundamental assumption.
I think moving people over to a digital currency. And it's we're either gonna go to a central bank digital currency, and
I think we're going there for sure.
Or we're gonna go to this sort of privatized stablecoin world, and I think that's the world that Trump's sort of angling towards. He's moving away from sort of the government controlled currency into the privatized world, and I'm guessing sort of that was the opposite of the previous administration. They were trying to strangle out that privatized world and I think, given enough time, would have moved towards a central bank digital currency. But either way, moving the world towards more of these stablecoin-like instruments for commerce, it's a really kind of clever way to create demand for treasuries in a way, because now all of your money is sort of backed. It has to be backed one for one. Has to be backed one for one in U.S. treasuries. And so in a weird way, regardless of which direction we take, it'll be an interesting creation of demand for treasuries, a new source of demand for treasuries.
I agree. And so this was always kind of my 2 cents on this. And my view hasn't changed in years. I think what crypto is a disruption to payments architecture rather than currencies. I think it's a disruption to the banks. I think it's a disruption to intermediaries. I don't think it's a disruption to national fiat. And I think the way you reconcile that is government digital currency.
I agree with you.
That co-opts the technology.
I agree with you, and I don't think it. Maybe there's somebody out there saying it's a replacement for fiat. I think everyone acknowledges that in this game, we're going to see more and more of these green pieces of paper that are worth less and less. And so I think that group believes you save in Bitcoin, you spend in fiat. And so I don't think maybe the maximalists feel differently, but I don't think it's a replacement. I think it's an acknowledgement of a system that's going to do what it does. And if you want to, so then our role is to try to find something that maintains and maximizes the value of our purchasing power over time. And a scarce asset that has all the sort of immutable characteristics of money is maybe a decent bet. I think that's.
And I'm going to
that's the idea.
I'm going to take you on a ride now.
Hold on. Let's come back.
It'll be short.
Okay, go ahead.
It'll be short. If Bitcoin then is basically the avatar for everything that's wrong with the sort of financial order as it's developed since the mid to late 80s through to now, for all of its benefits, we've gotten to the point where the people have decided that now, let's say the past 5-10 years, the costs have started to outweigh the benefits. For 40 years, the benefits outweighed the costs. Now we've decided that, look, the scales have tipped and something has to change. If Bitcoin is the avatar for that, if it's sort of the collective reflection of this thing you all have built over there is no longer working and we're not going to put money in it, so we need a new place to put money, so we're going to make us a place, then the resolution of the conflicts of the old order also crash Bitcoin. And if you believe that those conflicts do eventually get resolved some way, some third new way, then Bitcoin's purpose is spent.
What did you, I had this written down too. What'd you think about, I don't understand why nobody cares about this. What'd you think about them getting rid of the penny?
I frankly don't think it's that big of a deal.
That's the whole point. That's why they can get rid of this stuff one thing at a time. And nobody's going to care. But if you got rid of cash at once, everyone would care. But if you slow walk, if you heat the frog in the water.
I don't even remember the last time I've seen a penny.
All right, Uncle Moneybags over there.
other than one of those tourist things where you can take a penny and stick it in the machine and it'll flatten it for you and tell you you've been to Alcatraz. Congratulations.
Bro, private money is sovereignty. I'm telling you, the more we digitize stuff, the more conveniences you get, the more civil liberties you exchange in return for convenience. And if people do not, I couldn't believe it. It was just like a weekend headline. Nobody cared. Oh, the penny's gone, honey. And then everybody goes about their business. I'm like, bro, they are getting rid of your physical currency. They are getting rid of your sovereignty, one coin at a time, and none of you care. It's wild. I can't.
I'm not perturbed by the loss of the penny.
I know you're not. And it infuriates me.
If they phased out the $20 bill or even the $1 bill, then I'd get.
They're going to. Do you get it?
Then I get.
They're going to.
Then I would think about it maybe differently. But again, I do think that digital dollars and euros and yuan and all of this is where we're going.
Bro, and
that's going to be side by side with.
You say that so
cash.
Neutral, and you're just like, okay, if that's the world they give me, that's the world I'll take. There's no party that wants to fight for private currency.
I don't think it's a bad thing.
Jesus Christ!
I don't think it's a bad thing.
I feel like I woke up in this weird movie, and I'm looking around. I like
Black Mirror.
I thought everybody else. I thought
hey, this is we're headed towards bad things, right? And everyone's like, no, give me more digital currencies. I want UBI, please. And I'm just like, whoa, what's wrong with all of you?
Don't lump me into the UBI.
It's like,
no.
You know this is bad, right?
No,
hey,
UBI, yes.
You know there's poison in the food? Hey, you know what those shots are doing to you, right? Like, I'm looking around, like, nobody's... It's like, what? Are you a conspiracy theorist? And I'm like, what? No. He's a conspiracy theorist. Get him. And I'm like, oh, my God. What is wrong with all of you? Do none of you see where they're slow walking you?
I do not equate the getting rid of the penny.
I know you don't. It's all the same.
With the rapid descent into an Orwellian nightmare.
Dude, that's how they get you, bro. They don't do it all at once. Only in crisis do you get massive change. But otherwise, you just take a penny at a time, and take the nickel, and take the quarter, and take the dollar. Then, hey, we don't really use cash anymore, right? Yeah, because you took it all. Well, how about we do this CBDCs, and we'll start sending you a little bit of money each week. Wouldn't you like that? You like a little bit more extra cash? Yeah, I guess so. We'll give them to you in these CBDCs. Now, all of a sudden, you say something a little bit crazy and online, and your money doesn't work. That's the world you're going to.
I mean, Europe. People might say, and people have said to me before, why do you even entertain stuff like this? Well, because it's not far-fetched. Look at for all of my disagreements with J.D. Vance, and man, is that a long list. Long list.
You both
he
love
went
couches.
And scolded Europe about free speech.
You have the same love of couches.
Yeah.
That's such a made-up story, but it is so funny.
That whole thing was hilarious. That we spent so many weeks talking about J.D. Vance's couch. Man.
I didn't spend a single time. This is the first
me
time
neither.
I've ever mentioned
But if ever you wanted proof that idiocracy was prophetic, man. But anyway, the speech that J.D. Vance gave at the Munich Security Conference, where he scolded Europeans about free speech, he was onto something. I wouldn't have done it that way personally. I wouldn't have gone and used that forum or those words or that level of kind of airing of grievances against an ally in public. But there are countries in Europe that ostensibly have free speech protections that don't really have those protections.
Yeah, bro, they're throwing people in jail in Europe for Facebook posts right now.
Yeah, so
what I'm saying is there's people in here saying Victor's deep down the rabbit hole. I'm not.
Yeah, it's not that far-fetched.
I'm telling you what is coming. You don't have to believe me. You can call me a conspiracy theorist.
I don't think it's coming in this. I don't think it's coming in this country. I think we're through. I think we're through the looking glass on that. But
it's incentive. If I have the power, whatever power you give somebody, given enough time, it will be used. Which so if I have the incentive,
which is why fiat is going to remain dominant, because no government has ever given up the power to issue.
Oh, I agree.
Money.
I agree with you.
Yeah.
I'm just saying, when the day comes, just know that there was a crazy conspiracy theory guy who told you it was coming. And you didn't fight, and you didn't fight for it, and now your kids are going to have to grow up in a world where if somebody doesn't like what they say, their money, somebody has the power to change their behavior through financial decisions.
I don't think that's different from the world we live in today.
It isn't. I'm
not sure what the transformation is. That was always the case. If the feudal lord didn't like what you said at the pub this week, people would come and it would be the rack for you. Like this is where this is all of human history.
But this is a different level of control, man. With private currency, you can enter into private contracts and private business away from our feudal lord.
We think that, but we've learned that it's not the case.
No, it is true. But then what happens in Canada, right, when a bunch of truckers want to protest something, and then all of a sudden your boy, Justin Trudeau, decides to shut down all their bank accounts and all their friends' bank accounts. Guess how quickly that broke up that protest?
I bear no responsibility for Justin Trudeau's policies.
And what I'm telling you, it's not crazy. It happened already. Do you understand? It happened already.
Canada, and that episode in Canada was legitimately spooky.
So it's much easier, instead of debanking people, to influence people's. But it happens in China right now. This is how China runs. 1.5 billion people. It's through this soft level control through the currency. Go read it, and then when it comes to you, don't be surprised. All right, I'm so gonna get fired. I'm so certain of it. It's a matter of when and what topic. So when you turn on this show at 5 p.m. and there's like some new show one day, all you have to do is say, what did he talk about? What was the thing?
If ever there was a network where you could go down as deep into the rabbit hole as we do, this is it.
But I never get invited to do, like, when I started saying real shit, I never get invited to do real media anymore. Like, no way. He's too big of a risk. He might say something and cause panic. Before we get out of here, gold and silver, man. Any thoughts on this? Are you playing this at all? You're long gold, yes?
Yeah, I'm long gold, yeah.
Doesn't that chart look sick to you? That chart looks so sick to me.
It's an interesting thing what this chart is. This is either a consolidation, a very classic one, by the way. A technical analyst would call this a flag or a pennant. Either this is a very classic consolidation before the next rip, which is kind of the way I'm thinking about it. And I'm not convinced of it, so I have a very small bet on. And it's from meaningfully lower levels than this, though obviously it hasn't gone very far, so not that much lower. But it tried to break 3,200 and then couldn't, and then undid the break. So I got long there saying, failed breakdown. It sucked a bunch of people in thinking it's going down. This is where it's going to rip. So I have it on those grounds. But so either what this is an attempt to top, or this is a consolidation before the next big rip. And if I'm betting on a kind of basic recession scenario, let's go see the highs again. Let's get the bonds rallying. Let's go see the highs again in gold. The dollar is already selling off, and by the way, never really stopped. It's only kind of paused. But whereas stocks rebounded from April's holy moly, and bonds kind of went back and forth and unclenched, dollar never really strengthened. It just kind of paused for a while and has since taken more lumps. So this kind of seems to line up with what the break-evens are showing. These are the smarter markets, the markets that look through noise. So to me, this is sort of the world I'm leaning toward. More dollar weakness, more gold strength, stronger bonds, and stocks finally, once they really erase the entire sell-off, that's where they go, we started selling off on growth concerns, and then we went crazy on sentiment. Then we erased all of it on sentiment, thinking sentiment is all there was, but there was a growth scare here all along. Yeah, let's run that back.
In your world, in this scenario, the gold-silver ratio would get bigger, correct? You would expect more underperformance of silver relative to gold?
Yes.
See, I totally get that. I'm betting the opposite. I'm not shorting gold. I'm long the miners, and every time they give me a discount, I'm getting more long. I do think I think the miners are underinvested, and I don't think gold is going back down to 2,000 anytime soon. But I don't love. I trade with a pretty decent amount of leverage, so I don't love betting gold here. I don't know. I don't like the setup, but I do like the setup for silver, and it is, inching its way back up to the top end of this range at 34. It is just the biggest flirt. Just goes up to 34 and doesn't do a damn thing. Goes back down to 32. So I'm playing this range. I'm sort of playing it. It aligns with my idea. I think the gold silver ratio will come in, which means I'm not as bearish on stocks as you, though I totally see a world where gold continues to perform to the upside. But I'm trying to bet the upside in silver. It's just not paying. But this is one of those trades that it doesn't pay until it does, and when it does, the beta in silver is crazy. The moves in silver are insane. But the market has to stop being so afraid of bad outcomes in order for silver to do something.
I agree. And it's interesting that stocks are ripping as hard as they are and silver isn't, because it's a little bit more kind of oriented that way.
Yes.
And it isn't.
I agree.
And is holding up worse than gold, which is less sensitive to these kind of risk-on dynamics. So this is where I get skeptical. It's not that I'm not long stocks anywhere. I mean, I've been holding, for example, the Brazil ETF now for some weeks. EWZ is the ticker there. And if you look at the weekly, you can see where it's broken out higher. And it's had a long decline and now seems to have rounded a corner and started to head higher. So it's not that I'm anti being long any kind of equity risk. It's that I look at the S&P and I go, well, the risk reward here to be long kind of sucks. The risk reward is on the other side.
I agree, but not if we're going to 7,000. Then you'll look back
No,
and
not
say,
if we're going
the
to
risk reward is
7,000.
all right.
No, not if we're going to 7,000.
Go look at that bill, bro. They're running it hot. They're juicing it.
If they get it through and in its current form,
then will that change your opinion? Will it change your opinion?
My
somewhat?
opinion changes on the basis of one thing and one thing only. Does the price action move on it? Does the price action tell you that it's buying it? If the price action buys it, I'm not going to sit here and say I'm smarter than the market. No one is. If the price action tells you, you got to go where the price action takes you. Are we here to win academic victories, or are we here to trade markets and make money? I don't care if I'm right or wrong. I care about if I make money or I lose it.
All right, man. I always enjoy these conversations. I wonder, is there a poly market on whether or not this bill passes the Senate? I can't
one yet.
I gotta get into a VPN because it's blocked here. Polymarket.
Yes, the glorious freedoms are still available in the United States, but less so elsewhere.
Okay. You think it's funny? Keep giving away your currency and watch what happens. You'll be in the same place as me, needing a VPN to get to certain sites.
They can keep my non-existing pennies.
That's where it starts. That's sad words. Sad. You've just basically given up.
They've already taken my rotary phone. They can take the pennies with it.
Ilias Spivak, if the people want more from you, tell them where they can go.
As ever, I'm all over the PM, part of Tasty Live's daily broadcast. First Overtime, then Macro Money, then this show after the close. I'm on with Chris for Futures Power Hour, midday, Mondays and Fridays. I'm commenting at Ilias Spivak on the platform formerly known as Twitter and on Blue Sky. And I'm writing for the News and Insights part of tastylive.com. So all the stuff you hear me talk about, I also write about in a more cogent way. So if you don't want to hear it audibly, you can go read it visually.
Give me real quick before we get out of here, give me the news of the future. Let's imagine I'm having you on Thursday, the day after Nvidia earnings. Give me the news of tomorrow.
Stock markets fail. There's a massive move lower. Bonds rally, and all of it happens because of stupid reasons that nobody would seem to care about. So, and then people on Thursday are going to be trying to out-talk whether it was the FOMC minutes or the Nvidia earnings that did it, and it'll be neither. It'll be just, we're in a growth scare, everybody, and the headlines don't matter nearly as much as the reality.
Markets are too sick. They're not going to give you that easy answer. Here's what happens. We go down 1.5%. We end positive by like 10 points, by like 10 basis points or something like that. And then everyone's like, what was that? Markets don't give you answers, bro.
Wait, what?
But when you said stock markets fail, all I could think about is like an old-time newsie holding up like a newspaper. It just says stock market.
Dewey wins.
Yes. Yeah, exactly. All right, everybody
You'll
out
be about
there.
as accurate as that, too.
Yeah. Do me a favor, hit the like button before you get out of here. Subscribe to the channel, and I'll see you back here tomorrow with a conversation with Chris Vecchio. Same time, same place, same great network, only on Tasty Live. Till then, peace.
Peace.